So I have been doing trading and a lot of involved in the U.S. market investment for quite a while now, over 10 years. I've never invested in the India market. Now, given the macro situation that's in place, specifically that dollar is peaking, and with the inflation on and the Fed in US and across the world, the central government's raising the interest rate. So there is a bifurcation of the overall trading in the world economy is happening. One is the West and the US and the Japan, the developed world's economy is, which has, it seems apparently has peaked, and with the higher interest rate, the currency is also peaking relative to the rest of the world. So dollar as it's peaking, there is this outlook that over a period of time with this high inflation, it is unsustainable to keep this economic condition intact, as well as we think with a very high interest rate and with the outlook of staying this high or even going higher, the economy is supposed to shut down, and there is a lot of competition for the existing stocks with the bonds, with the money market funds. So with a lower growth outlook for the US and the Europe market, specifically for the US market, I want to emphasize on their alpha or the performance and beta in terms of the stocks, ups and downs. Those are probably better placed elsewhere. Elsewhere means outside the Europe and India, outside of the Europe and America, US. Now, India is one of the markets where the uncertainty of the Chinese companies, where a Taiwan war or any other geopolitical issue, and the tension between the US and China, there is this possibility of the total capital loss in China, and specifically with the very low transparency of how these companies operate there. If a company becomes somewhat very influential, for example Alibaba, it's possible that Chinese government would actually confiscate the CEO of this company and or the leads of this company, and then actually liquidate their asset to help their own purpose. That's how the communism works. So as far as people are making money, that's not a problem. So American investors is going to turn their head and just assume that nothing of that happens, and they're going to just take the profit. But if the things turn or the government really imposes more sanctions on China, then the money will come out of the Chinese market. So that makes India market is very, very attractive. So I think that if you look at the 1970s, so what happened was that the similar inflation happens in US, and actually the inflation was a little lower than this, but the interest rate was much higher in 14-15%, the Fed fund. And as the unemployment in 70s picked up, so the Fed reduced the interest rate, and then at the time the dollar sort of, as the interest rate goes up, the US dollar goes higher. As the interest rate goes down, and the relative strength of the dollar with respect to the rest of the currencies also goes down, and then the money flows from US to other markets depending on the sectors. So here as well, we have seen that last year the dollar picked, if in terms of the index, it picked from Dixie 100, so the 200 moving average was around 100, and at the time it actually went up to all the way to 113, and then it went back down after the when it seemed that the recession was almost even inevitable. That happened in the last year on October low. So then the dollar came down, but when the market realized that Fed is going to keep raising the interest rate instead of, then there's economy is still strong, so there is a very little possibility that Fed has to reduce the interest rate because there's no imminent recession. So dollar started picking again. Now, at some point, this economy is going to break, and Fed is going to pause. they cannot infinitely raise interest rate. But when the market kind of realizes that's going to happen, then dollar is going to fall again. And last year, when the dollar peaked and fell, then a lot of money moved to India market, and there's a boom in the Indian stock. But then when the dollar fell, along with the the Adani Industries this scandal, then we had this reduction also in the overall money went out of the India market back to US and other places. So I think this right now the Indian industry is when I looked at it. So by the way, I haven't looked up in the Indian the stocks ever these details. First time I'm doing this. And my goal is that because I anticipate that in the next 1 year or 2 years, maybe in 2024, when it's clear to the investors that the growth outlook in US is very bleak for the next few years, except in some areas where even in that case, we're not going to see the exponential bubble that actually formed in the last 10 years because the money has, as I mentioned, and other competitors, for example, the bond where you can get 6-7% for just a risk-free, tax-free US bond, much higher, close to 9-10%, maybe in a year or so, not right now, in HYG, which is investment grade corporate bond, or even higher for the municipal bond. So those are guaranteed money, almost like with very minimal risk. So people are going to actually park their money more when they do say that 2024 is not where the stock market will recover. So right now the money is sitting in the cash because people are anticipating something is going to happen. Fed is going to pause. Everything, the war is going to end, and then the money is going to start flowing in the stock market again. Now it's true that if the war ends, it is going to happen, but the outlook depends on your perspective that whether this situation is going to continue forever for the next few years. The China tension, the deglobalization in US, for example, US benefited the deflationary things that happened in the last several decades with the China producing for US. Now that a lot of this manufacturing US, specifically the political movement to bring back to US so that they don't fuel the China with the with all this stimulus, so that China economy becomes weaker and they cannot impose a threat to US. All this considered, I think that deglobalization is really in place here. So if you have that outlook, and even in that case that the war stops or not, maybe we'll see the bump in the stock market after the war stops, but eventually in the next couple of years probably we're going to be everybody realizing that okay, we are not going to go back to this previous growth scenario because inflation is going to stay here because of the deglobalization, everything coming back to US or the countries like developed countries from China, not everything, even like 30%, 40%, and the Chinese efficiency being lost, we're going to see much less productivity, much higher cost, and that's going to stay. And 10 years down the line, maybe we'll have a World War III. Maybe 2 years down the line, we'll have a World War III. There's different conversation that everything changes in that case. But if we have a inflationary scenario, the money is not going to be made in US. And in that perspective, I think in 1 year or so, India market is going to benefit. Why? Because it's a self-containing with a very high youth percentage, below 35 years. It has a very vibrant and very it doesn't actually, at some point it may not be requiring to do a lot of imports. Like China can make 80% of their stuff domestic. So India is nowhere close, but it might be getting there in few years if India kicks off in the right projects, specifically in the semiconductor industry. But irrespective of that, in other sectors, it's very much self-professing. So that's why if you look at the valuation, and everybody is not like we are kind of discovering something new, inventing something new. It is out there. The investors who have been looking at India for the last 4 or 5 years have been putting money in India, and India stock industry is very vibrant. So you can see that compared to China, the valuation of the Indian stocks are very high. So this is what we're going to talk about in this specific spreadsheet when we walk through this. So what I did, I actually picked up from my trading account, like we actually have this trading view platform, where I screened all the India stocks, right? They're like, there are, in this spreadsheet, you'll find about 1,370 stocks here, downloaded with this metrics. What are the metrics? So I'm looking at the price. The current price is taken from, I think it was like a few days ago, but it can change. I guess I should move this to Google Finance Dynamic. But anyway, it's a couple of days old, so it's pretty much all the data is still very relevant. The sector, then what industry it is. For example, energy minerals is the Reliance and the oil refinery sector. Industry and then sector is this. So we're going to talk about more segregating the sectors and seeing the valuation per sector a little bit later. This whole spreadsheet, this sheet is actually sorted by the market capitalization. So for example, the Reliance is the highest, like the biggest company here, followed by TCS, HDFC, Infosys, ICICI, and so on, right? So to this 1,300 companies or so. And then we have this 5-year performance. You can see that Reliance has a 162% performance annualized 5 years. If you actually put like a like for example $100, so you'll probably get 100 into like 162 compounded for the 5 years in return. So that's pretty good, right? So that's basically for Reliance, but we'll see that what it means for the rest of the stocks. Then we have this basic EPS, which is basically your price and your which is actually how much you're making, the earning per share for that in the last 12 months. TTM is a trailing 12 months. So last 12 months is actually very, very sort of a mean reversal happen in the whole world. So it's important because how India stocks kind of held up in the last 12 months can tell us that how it's going to react to the next 12 months more than if you consider the last 5 years average EPS, because a lot of things change in the last 1 year. So 12 months trailing indicators I think is valuable for this year, for 2022-23. Next year it might be different. Okay, so price to revenue, which is basically what is the price versus the revenue. So what's the ratio for that, and we'll see the medians and all. Then we have the basic EPS FY, which is this fiscal year instead of last 12 months. We will be seeing that some companies have the quarter ending in December as a Q4, some companies fiscal year ends in March, some in June, etc. So this is actually based on the company's fiscal year versus the last 12 months. That's the difference between so we will take for the medians values the TTM versus the fiscal year, because the fiscal year for some of the companies might actually be right now. Data for the 2023 may not be available, 2022 maybe not be available. Some already has like fiscal year 23 has started. Price to earning ratio, which is your price divided by your basic EPS TTM, and then enterprise value is your total like overall. This is another good valuation metrics. So you can actually, I'll probably provide you the link to how the definitions instead of I spending this time on the video. But these are the different metrics. Enterprise value, where the EBITDA is your earning before income tax and depreciation and of assets. So that's basically called the EBITDA. EBITDA kind of gives you that before the tax, what's your basically the income, and enterprise value is your all revenue plus your other aspects of it. So altogether, there's a definition of the enterprise value of this, and this is actually a good indicator of the valuation. The lower this value is, that means that you have a better, actually higher the value is, it means actually you have a better metrics. Total debt, then research and development ratio, which means that how much this company is spending in its R&D, and then price to sales. Quick ratio kind of tells you that how liquid this company is. Can it run for the next 1 year or so? Does it have enough depth? Price to book is your like total asset versus price. So lower it is better. Number of employees, last year's revenue, net margin, very important. What's the profit after all the expenses paid and everything? What's the, it should be in the high single digit, or at least in the high single digit, or at least more than single teen, low teens, higher it's better. Net income, so net margin and net income is actually sort of net margin is computed after the net income. You actually remove all this tax and other expenses, then you get this net income. Net income quarterly, revenue year over year, gross profit, free cash flow, very important metrics. What is the free cash flow after all the loans and everything paid off? Then the company have a free cash flow growth year over year. That tells you that this is a very good indicator the company is going to survive in this high interest rate environment. Even in India, interest rate has gone up in the last 2 quarters. So it's important that the companies have a growth in the free cash flow. Doesn't matter what happened in the last year or last 12 months. If it has a growth projected, is it going to meet? Is it meeting this growth projection? Quarter over quarter, and that's actually one of the key metrics we're going to consider while picking the stocks. So EPS forecast for the next 12 months, next quarter actually, that is available. I don't think that in this particular case we, specifically for the India stocks, we had the EPS forecast for the next 12 months available. So I only got for the next quarter, which is not very useful. Anyway, so we will consider that if you can find this forward-looking EPS for more stocks. Return on the equity and the return on the assets. These are again key metrics. This is basically tells you that higher the numbers is better the valuation. Return on the investment capital. This is another key metrics. That basically you find out that what's the capital investment and what is the return on that. So the stock price higher for the least amount of capital invested, it's better compared to its peer. So that's how you can evaluate one peer versus another peer in the same sector to see that which ones is a better investment versus the other. EPS diluted annual year-over-year growth is usually same as a basic EPS. In some cases where the ownership model is different, EPS diluted would be a little lower than the EPS basic. EBITDA annual, so we talked about the EBITDA, the dividend yield, exponential moving average. These are technicals. What is a 200-day moving average? What is the relative strength? So relative strength at 30 or 20 you can say is when you have to buy the stock. It's overbought unless the fundamental is totally broken. If the fundamental is okay and the RSI is around 80, then you have to sell the stock. Unless you are a very, very long time investor. Then all-time high, 52-week high, 52-week low, 1 month low, 1 month high. Fibonacci series. So Fibonacci is a very important technical term. Basically, you have this, you can look up what is Fibonacci series if you're not aware, but R1 actually says that with the next level where the stock is supposed to get a resistance, the R3 means that if it crosses the resistance 1 and 2, that's the highest level resistance at R3. So basically you have this Fibonacci goes like this. So if it's between 2 time series, if it's a 0, if the stock was at, let's say last year lowest was $30 and in the last 1 year the highest was $60, so 30 and 60 is your Fibonacci pivot points, and then you compute what is the 22%, what is the 38%, what is the 50%, 62, 78 and 100% of the price range, and those becomes your S3, S2, S1, then P point, P is a 50%, and then resistance is your 62 R1, 60, 78 R2, and then finally the R3 is 100%. So these are basically your different resistance points. What is a beta? That means how this particular stock has performed up or down compared to like when the S&P or the the overall stock index was down, how much comparatively or up, how much comparatively this particular stock moved with the market. So 0.93 means is moved slightly below the market or moved slightly above below the market, both up and down, and over 1 means it moved more than the market for the same event. Then recent earning date, basically the Reliance earning, for example, first one was on 120, and then forward PE. Ignore the forward PE because it was calculated, I believe, using the MRQ, which is the quarter. So I guess we can ignore that. I'll remove that later. So now we have all these stocks with all this metrics. Now if I compute that, the key few metrics I care about. All the metrics are important, but let's say we want to kind of look at the first level of the filtering and use the 5-year performance, the trailing PE, the price to book, the net margin, the EBITDA growth, and the revenue growth as the like for these particular sectors, dividing all this between like around 20 sectors here for the Indian market. What are the performance, what are the different metrics for this? And then we have this median. These are the median numbers, and then for the 5 years, and for each of this we also have this overall for the stock market, what is the median. So here overall stock market median is 35 performance, like if you actually put like $100 on this market, so 135 would be a return after 5 years. So that's basically your yardstick for the performance, anything above. So let me show you how did I calculate that. So if I go and if I go and look at the formatting, so I have used for this particular case for the performance, if it is 15% or below, then it's red. If it is midpoint is 25, if the performance is 25, it's yellow, and if it's above 35, which is your median here, then it's green. So that's how this heat map is calculated. Now trailing PE, it is if you can see 16 is your trailing PE for the overall stock market for the sector. If you're seeing that it is above 35, so lower the PE is better. So if you're seeing that mean point is okay, 1 second, let me just check if I'm actually having it right. So I believe I have this right here. So if it's lower, it's actually should be better. Yes. So if it is 17 or lower, it's green. Then if it's at 22 or above, it's yellow, and then 25 or above, it's red. So trailing PE, lower the better. Price to book is lower is the better as well. So you can see the 3.1 is a median for the stock market in India. So here 3.5 here, anything which is so here again I'm going to open up the format, and if I kind of click on that, you can see 2.8 is green. Why? Because 3.1 is actually high price to book ratio for example compared to the US market. So I took a little bit of discount here. 2.8 is still high, but let's say 2.8 based on the Indian market, I'm considering that is green because market is really high evaluated with a high valuation right now. With the value of the market is low because the PEs is standard PE. You can see all the 16.2. The price to book is high. So basically with the 2.8 we're going to get green. Anything above 4 is between 4 is your midpoint is the yellow, and 6 above 6 is really high. It's expensive company, so that's 6. Net margin looks like the 8.7% is your net margin for median. So you can see that the greens are again, let me just walk over this. For net margin we have 5% or below is red. 8.7, which is the median here, is yellow, and anything above 12 is green. So you can see that so I'll also walk you through the rest of the stuff. Probably should be aligning pretty much well with the revenue growth as well as the EBITDA with the net margin, but you can see that I'm not going to go over each of them, but this is basically 12.3 is your EBITDA growth, and anything which is way above it is actually pretty good. And also from the revenue perspective to 20.4, anything well above it is good, and anything below revenue growth is anything below like 10%, 12%, that's kind of red. So here we have this overall sector by sector evaluation. So now you can see that the commercial services, now if I double click on this, I'm not going to do that for all of them because of the video will be too long. In that case, it's already very long. So if I look at the commercial services, what are the different companies coming that, right? So for example, if I go and do a filtering here, and if I sort of let's say I'm going to freeze that top level here, I'm going to show you the consumer services, because India is a consumer-based economy, just like US, just like China, because of the big population, and it's not an export-driven. Is the internal consumption is very important here. So what we're going to do is like we're going to sort this based on the capitalization, market capitalization. So we're going to do the Z to A, and here you can see LTIM, which is Mindtree. I don't know which company is this actually, but anyway, LTIM. It's just the metrics, so I don't have any sort of preconceived bias on any of these companies because I know very little about any of these companies in India. So that's a good thing in a way that it doesn't introduce bias. Also the bad thing because I don't know the internals. So I'm looking at purely at the data. So here, based on this sector, which is your commercial services sector, looks like these are the companies which is in this sector. And here, this is actually a good area because you can see a lot of greens here. Obviously, the trailing PE that tells you the 24 versus 16 for the market, that means it's expensive, but it's not hugely expensive, and I believe should be equivalent to sort of a discretionary sector in US in the S&P. In that case, we can say that comparatively to US discretionary, which is tracked by XLY, this is pretty comparable trailing PE. So if I ignore the trailing PE as expensive, the performance is super, 46% versus 35 for the Indian market. The price to book is okay, it's not terrible, but it's expensive. Net margin 11.4, which is good, not really great, but good. EBITDA growth 18%. That means every year the earning power is growing 18-20%. That actually will tell you that you're okay to have a 20 PE. It's a slightly expensive 24.7 PE, but if the market comes down, then EBITDA growth at 18.5. If the market in general is in the growth sector, then I think it's good. Revenue growth is excellent. 30% revenue growth is no kidding. It's really, really good. Obviously India with this population and everything else, so revenue growth of 20% looks like the median, so 28.5. So this is actually a green sector. I would say it's a good place to buy. So we have to then choose which stocks to buy. So this is kind of give you the indication. So I'm not going to go over each of them, but this is kind of the methodology I used to sort of isolate that which companies within those sectors I should be looking at based on the macro, based on the broad strokes, and then I can pick and choose the stocks based on the valuation. I'm going to go over this next, and then we can see that there's a high. I would say that as you go with the valuation, you have a bottom, you have a floor in place. And then the chances of you losing a lot of money is less. You can always lose money in any investment, but are you going to be actually losing 50% of the money if everything goes down? Maybe, but maybe that will not last long. It's actually going to pick up because valuation is strong. Market will identify that, and it's going to pick up. So, for example, if you actually go for the frothy stuff, which actually has a high potential of like a return, but actually it might. It doesn't have a good valuation, it doesn't have a good cash flow. Most likely what will happen in a bad situation, you're going to lose a lot of money, people are going to flee with their money. But if good valuation stock, your return might be limited. In long term, the return might be better, but short term, you may not get a huge return, but your loss will be limited. So if you have a lot of capital to invest, you want to invest in the high valuation stock. You have a small capital to invest in the crypto sort of areas, or areas in the biotech stock which has losing money but has a high potential. So those kind of you have to balance your portfolio based on that. So here we're going to pick only on the valuation basis, because the rest of the stuff, the beta and everything else, it requires a different kind of metrics filtering. We're not doing that here. So we chose that how we're going to actually look at the sectors, right? This is how. Now if you look at the commercial service, all these stocks, then the next step would be to pick the stocks from this list if you want to invest based on the sector. So here, for example, in the total market, you can see that commercial service is a good place to be. From energy perspective, energy minerals is a terrible performance in the last 5 years. If you put $1,000, you're going to be basically getting near $700 after 5 years. So you lost money in the 5 years. But everything else, right? Price to book, the trailing PE, the net margin is okay. It's not great, and that's why you're losing money, because comparative to other industries, you're really getting not a great net margin. But net margin is still positive. It's still near 10%. It's still above the net margin of the overall industry. So basically, it tells me that this is the best sector to invest in. So we need to delve more into this sector, because if overall the doomsday is coming, everybody is raising interest rate, the inflation is going to percolate through the rest of the world. From US, it already has, but if it goes worse, then this is the sector which is going to be the new alpha which is going to be make you money, because the valuation has floored. It can only go up from there. And if you think about the tailwinds of the energy, because we have this inflation and because we have this deglobalization happening, so we are going to see a lot of good things come out of it. So this is my favorite industry at this point. I do not want to invest in the oils and areas where actually we are going to be bad for the environment. I mean, that's why I have an electric car, because although it's expensive to get an electric car, but I want to actually be investing on green stuff. But you have to separate it out a little bit in your investment policy, which one's actually going to make you money and which one it's whimsical and you don't want to invest on it because it's somewhat against your value. So it's a right balance. But for me, we have to pick the stocks in the energy mineral section, which actually with the best valuation, best potential, but also not so bad for the environment. So we're gonna look into that more in the next videos, where we're going to evaluate various individual stocks. I'm going to just give a glimpse today of this spreadsheet, of this methodology that we're going to use. Okay, apart from this, we also see that probably I would say, okay, transportation looks like pretty good. The net margin is not that great, but I think overall it's all looks good. It's green. Trailing P is a little on the higher side compared to, for example, energy, but I'll live with it. 18 is not terrible, where 16 is your trailing PE for the market. Now, utility, I think utility is the one that goes up and down with the interest rate. It's a function of the interest rate. For example, like in the US it's PG&E, in India maybe in the CSE, they provide the electrics and stuff, the water. Those are the companies here. So they are actually always trail is the high multiple, but here it's 13.4. That tells me the interest rate in India has not peaked yet. So that's basically one of the areas that we want to kind of consider, but it's all mostly green. EBITDA growth is low, and that's probably the reason why we have this low multiple. So we picked transportation, we picked energy, we picked commercial services. Now let's look at the technology services. Fantastic return, 123%. $1,000 becomes like 2,000, whatever it's like, but multiply by 123, you can basically get 1.23. You can get basically what the number is. And in this sector, and obviously we have ups and downs and max and lows in this sector, so we're going to go into that. But if you look at the trailing PE, it's in the higher side. Price to book really high. Net margin not that great, right? It's 12%. But industry 8.7. So I'd say it's expensive. EBITDA growth 19.8. Compared to that with the energy, it's energy minerals at 32.6 EBITDA growth, right? So I think it's a better sector in energy versus this. The revenue growth is also not that crazily high. So far it seems okay. Healthcare is another one, right? Health service and the health technology. Here the performance is not that great, 17% below the performance of the sector, 24 high PE. So I think it's actually not that great, compared to the to overall consensus. I think it's actually expensive. Health services, similar story. Finance and then bad performance, but overall, if you look at the valuation, it's pretty good. So these are the couple of sectors we can kind of intersect later on. Process industries looks okay to me here as well. So we're gonna delve into each of this later on. Now let me give a quick glimpse of, again, we're gonna slice all the stocks that in the first all stock section, this 1700 stocks or so, with this filtering, which is the cash flow greater than 5%. So we talked about the cash flow earlier. Then we have a free cash flow growth is high. So let me actually go and check the pivot points here. So what are the different filters I used here? Okay, here are the filters. So free cash flow annual year-over-year growth is greater than 5. Revenue year-over-year growth greater than 10%. EPS diluted year-over-year growth is greater than 10%. Market capitalization, which is how big is the company, is greater than looks like greater than 80 billion rupees, which is equivalent to almost $1 billion, which is pretty big industry for India. So we actually sorted with this, and then a couple of more filters. The net margin is more than 8%, which is the industry standard looks like in India overall. We just saw in the previous tab, and the EBITDA is greater than 10%, which is I think in 12%, I believe, which we saw. EBITDA growth is 12.3, whereas here in this we took 10%. Now, if I look, filter with this, we come up with the 50 stocks, and then we can actually evaluate that out of these 50 stocks, which ones actually make sense. Now we can actually slice it by the industry and all later on. Let me actually do that. Let me just put the industry here as a column. How do I do that? Maybe I cannot put the industry in the pivot. Maybe I can actually just put it in the separate row. Let's see if I can do that, or sector rather. It's going to mess up the whole thing, so I'm going to kind of avoid this to do that. I'm going to find a different way, but basically if you look at the individual stocks, and we're not slicing it by the industry, you can see some of the greens. So I actually worked on this a couple of days ago, and I highlighted the ones which are, I felt like those particular companies has a reasonable valuation. So here, for example, I did not choose let's see, Reliance. Why? Reliance is a 162% performance. However, if I look at overall return on asset is 4.3. I think I use a different metrics for it, and the average of the price. So I think this is also what is this one though? Average of the price. I don't recall this one. Let me check one more time here. Oh, okay. So this is actually the price of this. Okay. Yeah, so I think why this is yellow, that's the question. What is the filter that I used here? Let's look at the filter. Otherwise, overall Reliance looks good to me. Oh, okay. So this is why it is yellow, because it is, so we're looking at the 200 moving average, which is the column J2, J. So J is your 200 moving average. So if your stock is well below the 200-day moving average, in the case of the Reliance, technically it is 2495, but it's 2414. So it is yellow because it's falling, between 90% and 1. So it is actually very borderline of the 200 moving average. So it hasn't broken down the moving average higher or broken down to lower. So it's in the yellow range. So if it goes above the 200 moving average, it's probably a good time to buy. But right now, probably this just wait. So technically, Reliance is not a great stock to buy this point, but buy when it goes below, this 90%. Basically, if you go to red, then you can buy, or if it goes above, then you can buy. So if it's red, for example, let's see if I go to this format, conditional formatting again, and if it's below the 90%, that means it's a solid industry. It got oversold because the 200 moving average is. I think I should also look at the weekly RSI. I'll add another column which tells you that it's oversold condition or not. But if I look at the industry, like Reliance, and all the metrics kind of looks good and mostly current, and it's sold off because the market sold off, and that's why it is below 200 moving average, then I would buy this. So that's why it is not recommended. That's why it is not highlighted with the red. Oil India, it's my favorite here. So 12-year performance not that great. I don't want the top performance now because the market reset has happened last year. So I think that if the Oil India and natural gas, these two has a bad performance in the last 5 years, but because the evaluation is good and energy is actually taking over from the technology as the most. It's going to be the weighting higher. Weighting right now in the S&P, for example, is 5% versus 25% of the technology, and the earning for energy sector in S&P in US market is actually taking around close to 20% the earning of the S&P. So it is actually not properly weighted. There's a dislocation of the earning potential of the energy sector versus the weight of the energy sector in the industry in S&P. Similar energy related reformation with the electric, with the hydrogen gas related, like clean energy, all these things are happening. Oil price is getting higher, a lot of people are saying. So, because of this Russia war, all this together the energy sector is probably going to get a boost, and that's why people are overweight on the energy, and we think we should too. So I'm going to pick the stocks, and looks like there's the two stocks in the energy sector. Probably there are more which are good here. Here is a 17.7%. That's why it's kind of left out in this. In this, it's not highlighted as a red as a buy. But if you look at the Oil India, all the metrics checks out, and it is well above the 200 moving average. So I would probably buy this right now, right here. Okay, if there's a pullback, even better. So NTPC is another one. I think it's kind of like, okay, the net income growth is red, but everything else looks fantastic. The return of an asset is a little low, but I think it's still that's one of the areas where most of the stuff's kind of checked. It's a green. So this is basically a screener. So you can take a look in these industries and see that which of these companies you can search for individually for this. But this is my valuation metrics. Take a look at these companies and see that which ones makes sense. Again, the EBITDA growth, we talked about each of them. The green, yellow, red is based on like generally on the industry standard. So this one is, for example, higher the better. EBITDA growth, return on asset, higher the better. Free cash flow growth, obviously higher the better. Net income growth, higher the better. Price to book, lower the better. Price to sell, lower the better. Trailing PE, not training PE is a typo. Trailing PE is lower the better. So obviously India market is expensive. I'd rather have an 18 PE or 17 PE, but India is growing, so 18 PE probably means that for that specific company, the growth is not as high as the rest of the market in India. So we have to find that why the growth is not high. Is that because there's a market shift is happening at this point in 2022, or is it because perennially low? So we have to look at the cash flow growth versus the PE and the net margin, and see that if there's a possibility. The one missing part here in this evaluation is the management. So there is no way I can actually evaluate the management from here. So analyst numbers also comes in. I mean, depending on also if some stocks are covered by many analysts, the upside potential is very low. The downside potential is also very low. So you have a risk reward, like you may not actually get a whole lot of beta out of that stock if many analysts are covering that stock. Whereas in some of these stocks, after you pick and choose, if you find some stocks really stands out in the valuation metrics, but not a lot of analysts are covering, maybe one or two, that's your dark horse right there, because you might have a high beta because you actually did your homework to see that the valuation is really good, but not a lot of people are looking at it because for whatever reason it's not part of the ETF, not part of the company that covers all that stuff. So you might have found a canary in the gold mine, the diamond, which you might want to stick to if you are confident that your valuation is good. So do as much as you can, specifically on the management side. All the other metrics are right here in the sheet, but if you know the management is good. But one thing I would not do in a market where I don't have no preconceived notion, no bias, is that go outside and see that if people are saying buy this stock, buy that stock. I would not do that because most of the time those are misplaced. So Reliance, for example, is maybe one of the stocks that stands out. So if it's a very high, if you want to kind of make a good 10%, 15% return, maybe that's a good strategy if it's a very high market cap stock, because its chances of, and the valuation is good, so the chances of it going down is bad. So if it's a Reliance or TCS and those kind of companies with the market valuation is over like $10 billion, then maybe it's okay. But if you are looking at some random company and really not a very high cash flow, not a very high net margin, and people are buying that stock, I'd say stay away. So look for your opportunity later on. So that's a long video, so I want to kind of cover this, but next editions we're going to pick and choose each of these stocks. We're going to go in the total market, we're going to look at the sectors, we're going to expand the sectors. For example, we just did with the commercial services, and then we're going to actually look at apply the same valuation metrics, color it based on the heat map, and see that how we can choose specific stocks from the sectors, and based on that we can really put a little bit of money at a time, maybe 1,000 rupees, 10,000 rupees, whatever it is, and do a pilot and see that how it reacts. Obviously, this is not a trading platform. Trading is different. I do trading on the US market. I will not be able to do trading on the India market because I'll not be waking up all night long monitoring the stocks, because trading, if you want to do that, you want to be right all the time during the stock market. When the stock market is open, you're going to be sticking to your screen. You're going to be looking at the price action all the time. For long term, you don't have to do that. You look at the valuation. You buy the stock which has the lowest valuation, and market sentiment dislocation. And so you pick those stocks and wait for your turn and sell at a good valuation. So that's basically the metrics, and we're going to talk more about it in the coming videos, hopefully.